Everyone. I have another special guest today, again from the fund management industry, none other than Mr. Harish Krishnan from Kotak Mahindra Mutual Fund. He has over 15 years of experience spread over equity research and fund management. He has a Bachelor of Technology degree from Government Engineering College, Thrissur, and he is also a graduate in management from Indian Institute of Management, Calicut. Of course, he is also a CFA charter holder. Mr. Harish, thanks for agreeing for the call, and it's wonderful to meet you.
Likewise, it's always a pleasure to connect and looking forward to an interesting interaction.
So, Harish, while giving out your brief bio, I see that you came from an engineering background, you did your IAM management degree, and then you got into fund industry. Please give us some insight into why you selected this industry and your journey over the last 1.5 2 decades, and what kind of insights that you can give us in your journey.
Sure. So I came into this industry by accident, if that is at all possible, because getting into buy side clearly is extremely difficult, as many of you may be aware of. I had always an interest in quant. I had always an interest in finance, but my primary interest was in strategy and management, and you can say marketing. And by some sheer luck and chance, from my B school, got placed into 4 or 5 different companies. And at the end of the day, all the other 4 companies, I had a IT background prior to joining my B school. 2 or 3 of them were from the IT background, and the couple were from the marketing domain, etc. And I thought that among all of them, this finance profile seemed to be the most outlier, and I thought I should at least give it a shot to try and see whether because all others I thought I could always get back into those industries or those roles. So you can say by sheer accident I got in, and now that I am in, I can only thank my stars how incredibly lucky I was, and also my decision making of pure serendipity, if I may use that word, to get into it. Because once I have gotten into it, I completely love what I do, and in some sense, it's been my true calling. So I never planned it this way, but this is how it's turned out.
The stars were already aligned in your favor. We are glad that you joined the fund management. Right. Now, in your profile, I had read that you believe in first principle investing and also behavioral finance. We don't hear much about first principle investing in general. So for my audience, if you can explain that in general. And the markets are down. We are recording on April 19th. So a little bit about behavioral finance for those who are worried about their portfolio and stuff.
So first principle isn't anything but common sense. I think that is this general sense, and like you said, I come from an engineering background, right? And the typical sense that we have is everything can be computed, can be put into numbers. If you have run a DCF and get an accuracy of 2 or 3 decimal points, you have the feeling that, oh, you've arrived in life and you've conquered what needs to be conquered, right? And so my journey started pretty much like that, right? Wherein the idea was to get the inputs right to a reasonable amount of certainty among, obviously, while everybody knows that these are assumptions and therefore they are there will be variances, but the idea was to get that right. And over a period of time, what I had realized was from my B school into the career of fund management, that there have been these thumb rules which started coming through, right? Low P, high P, what is P? So everything became a derivative from the basic knowledge of reading a balance sheet. It became about understanding those ratios, understanding those things which were rules of thumb. And anyone who's been through the markets over, say, 2 or 3 business cycles realizes that that is essentially borrowed conviction or borrowed thinking. And over a period of time, you realize that that is not a way in which you can sustainably build an edge in fund management, and which is where you need to further synthesize, you need to further get into the first principles to try and understand what is it that a company does. And once you start doing that, then it is all about common sense. And starting out from the other dimension is that of behavioral finance is also common sense, in the sense that I mean, we all like to believe that we are all rational people, we are all logical people, but we all know that we end up doing illogical things, or things that that we can try and rationalize through some behavioral, mental model that you can have. And when you have the overall markets having a particular psychology of the markets, that is where the liking and the passion of behavioral finance comes through. So if I were to join both of them, I would say that, first principles is basically what you as an individual assess a company for what it stands out for and what it means for your portfolio. It's your assessment, right? Behavioral finance, in some senses, what the market gives us a reflection, what is the feedback loop that the market is giving. It could be on that particular stock, it could be on the particular sector, it could be on a particular asset class, but there are important signals that the market is trying to reflect back on. And if you can combine both of them, obviously it's easier said than done. And I myself am in a journey where I'm hoping that I'm getting better at it at each passing day. But when you do that, I think that you are adding a valuable signal of your analysis, and you're removing out all the noise of thumb rules and all of that, and getting in pure signals from the market, and hopefully when you combine those two, you can make slightly better decision making. So that's really where I stand between the intersection of both of these areas.
Interesting. Getting the right signal from the noise all around us. So let's jump a little bit to the funds you manage. You manage five funds, if I'm right, and most of them are flagship funds from within the Kotak fold. I saw that the infrastructure fund that you have been managing very successfully. India is on the cusp of seeing a lot of investments in infra in particular. Give us a little bit of insight into where you see the infra push happening in India and your views in general.
Sure. So infra is, obviously from a demand side, there are four engines of demand. And while most of us think of infra as primarily government, and government obviously catalyzes a lot of that demand, but there are four varied demand sources. The first engine is government spending. The second engine is private sector capex. The third engine is housing. And the fourth engine is, what in the earlier cycle got to be known as public-private capex, which is unleashing the complete animal spirits to try and make it. So the broad thinking that I have is that when all these four engines fire, that is the time to get worried about, because then you're pretty much running on full throttle, so to speak, right? At this point of time, we've been through a very painful decade of deleveraging, getting overall corporate India's balance sheet back into shape after a significant amount of excesses and misallocation of capital that we saw in the pre-GFC era. And it's taken us slightly longer than what we would have liked. But at this point of time, thankfully, our balance sheets of corporate India in aggregate are in the best of health that we've seen in the last 20 odd years. Add to that, you've got, say, 4 or 5 key changes that have happened. You can, without going into greater depth over that, I mean, I'm sure we all know about PLI initiatives. We hear about the government push towards creating reasonably strong infrastructure. You also have got, say, for example, the tax cuts that got announced specifically for manufacturing, new manufacturing firms at 15%. It's the lowest in anywhere in the world, which can attract. We've seen, for example, our biggest competition as far as infra and manufacturing is concerned is China, right? If you, I mean, obviously we all look at, say, the forex trade in the form of USD INR cross. But if you look at, say, the CNY INR, which is the Chinese yuan to the Indian rupee, it used to oscillate around 9.5, 10, pre-COVID. And today it's close to about 12. So essentially our currency has become slightly more competitive by about 15-20% in a pre-COVID and a post-COVID world. So when you add all of these and then you start thinking through that government spending is good, but now you've got private sector balance sheets in good health. They are talking about capex. You're talking about housing, which again went through a long period where pretty much nothing happened. Housing prices have been stagnant, and now inventory is getting cleared out. That is starting to move up. I think PPP is still a long time away. So when you look at it in that construct, I think there's still a reasonably large cycle to play out over the coming course of the decade, and that is what underpins our relative positive bias towards the space in an aggregate.
Interesting engines. So keeping to the same theme, how do you see the higher commodity cycle playing out, and the worries about inflation in general, not just in India but in the Western world also?
So I think commodities has got two elements, right? You've got the supply element and the demand element. Now, in my view, is that the demand has been soft even pre-COVID, and it continues to remain soft. So structurally, the world has aged. The world has gotten more and more prosperous, which means more and more money is going to services compared to goods. What changed really for igniting that entire, the super cycle of commodities was essentially free money being given by the Western world in the form of checks to citizens, wherein trillions of dollars, especially in the US, were given to citizens every month. And in an environment where services were pretty much shut, so free money, services shut, and services account for, say, 60 to 70% of overall spending. So when you have that, you basically have pushed all the spending going to goods, which meant that there was, and goods are more energy and more commodity heavy, which has pulled up the entire chain for them, right? Because the world was optimized on a particular demand curve, and suddenly you've seen a lift off of goods explosion. Now, the question is, I think, generally with higher prices, supply needs to come through because that's the response of higher prices. But I suspect that the suppliers also know that, this demand is a temporary demand, and demand will phase off, and therefore they're not bringing in capacity, which means that prices are staying longer than what any of us, I'm happy for the producers, but as a consumer or as the world as a whole, I think it's taking a very high price. So we did this analysis wherein we said that between CY19 and CY22, the world is likely to add close to about $7.5 trillion of economic output in form of GDP, the incremental delta in GDP. At current rates of, just the basic food, energy, and metal prices, and these are basic commodities, right? Of that incremental $7.5 trillion, close to about 55 to 60% goes only into these basic commodities, which generally otherwise is, in single-digit terms. So that's the extent of extra money that the world is going to allocate into these commodities, which means that there is going to be pressure in somewhere else, right? I mean, the wallet is only so large. So therefore, I would suspect that there is going to be demand destruction. It's not a pleasant sight that, ideally we would want the equilibrium to happen without a significant jolt, but it appears that the solution, because suppliers are not bringing in capacity because of higher prices, because of the reason that I said, therefore the only way should be to reduce demand. And in certain cases, I think it's already starting to play out. With higher interest rates and the higher commodity prices, I think we are poised for a chaotic kind of a macro environment globally, and hopefully we arrive at an equilibrium sooner than later. Is what I would hope for.
Interesting. So with this market uncertainty and of course the geopolitical tensions, between big nations, how have you positioned your portfolio, and what should an investor, a retail investor who's investing in your funds, should be aware of?
So I think, firstly, we don't really focus on the near term. I mean, typically, if you look at our turnover ratios of the funds that we manage, it's in the region of about 25 to 30%. Effectively, therefore, a stock has got anywhere between 3 to 4 years of minimum life that we give for these companies to execute their desire or their stated goals. Given that, and obviously at any 3 4 year period, I don't think we'll ever get a sweet patch wherein there will not be any uncertainties or there will not be any untoward incidents, right? And therefore, I mean, obviously, one can be paranoid about it, but beyond a point, there is nothing we can do about believing that the world order has changed, etc. At least that is not the base belief. Yes, it is unfortunate what's happened, but I think the world will arrive at an equilibrium in the way that it sees fit, and therefore our focus is therefore which are the companies which are best of breed. That is our underlying investment focus in our funds. And what do we mean by best of breed? We are essentially saying that every sector is cyclical. Certain sectors will have transient headwinds, certain sectors have structural headwinds. Now, how do we differentiate between both of them? We look at the supply side. Wherever there is consolidated supply and there is pricing power, we tend to prefer such sectors over other sectors which have too much fragmented suppliers and lack of pricing power or regulations determining pricing. Having said that, once we arrive at those sectors and these companies, we believe that in every sector there are maybe 3 or 4 companies which are very differentiated and which show through in terms of either better margins, better return on capital employed compared to the rest of the pack, and also tend to take higher market shares, which means that they are becoming more and more relevant to the customers. And to us, those franchises will tend to grow in value over the course of the next 2, 3, 4, 5 years. And therefore, if we buy into them and back them, especially during times when there are transient headwinds, we tend to kind of make up for that uncertainty or that greater period of volatility, if you may say so, with slightly better returns compared to the rest of the market. And that is what we think over a 3 4 year period, an investor should expect that. So we don't really focus on obsess over the next 6 months, 12 months, how the portfolio needs to be positioned, how they need to be changed. Of course, we'll maybe 2 or 3% of the portfolio may be shifting, but that's about it. The rest of the 97, 98% of the portfolio is still geared towards those 3, 4, 5 year kind of a horizon that we think an investor should at least be looking.
Very interesting. If I were to ask you to sort of do some sort of a crystal ball gazing, if I may, you mentioned about 3 to 4 years. Once it till whatever time it takes for the geopolitical tensions to calm down, markets to bounce back. Any sectors, if you can, that you see as the future beneficiaries, and any sectors that probably can be a laggard with the changing times.
So yes, obviously, in 3, 4, 5 years, a lot can change, right? And therefore, you need to constantly be checking whether the structural underpinnings have moved, or is it only a noise that has come through, which is causing something, right? So with that caveat, in the sense that, this is obviously prone to change almost on any given day. I would say that there are 2 sectors that are looking much better, or two themes, I would say, which are looking far more promising in the next 5, 7 years compared to what they were doing in the last 5, 7 years. The first space is, I would say, export from India, both on the services side. I think we've done a phenomenal job, and COVID is kind of further reinforced the fact that Indian companies could deliver, because the whole world was in the same blind, right? So at the same point, everybody was scrambling how to set up redundancies and all that, and here you had a way in which you could actually do it and deliver it at scale. And I think that definitely augurs very well for the overall Indian services space. But also in terms of goods, I think we are starting to get our act right, because of all of those reasons that I spoke about when we spoke about infra, when we spoke about tax cuts, currencies, and a whole host of others, including the geopolitical developments that have happened. I think there is a growing importance of India as a strategic partner compared to many others. So I think export and that entire value chain, that will be one area that I would look out for. The second area I would say would be the investment cycle starting to come through. Because this is again, like I said, it's almost been a 10-year kind of a phase wherein there was a double deleveraging. Both the banking system or the financial services system was deleveraging, and you also had the corporate sector deleveraging at roughly about the same time. And we are, I would say, closer to the end of the tunnel than where we were, 2-3 years back, and that gives us confidence that we can get the investment cycle kick-started. The one area where definitely there is a spot of bother at this point of time, I would say, is bottom of pyramid consumption, because essentially COVID has, I think, impacted both savings and income profiles for the bottom of the pyramid. Of course, the rest of the world, gave those free checks to everyone. India, given limited resources, hasn't been able to match that up, rightfully or wrongfully. Of course, they did give a lot of support in the form of free ration and all of that. But at the end of the day, it is going to take some time before livelihoods are regained and savings and income profiles start coming back. And that is a space that I would say where there could be a spot of bother, unless there is some serious government intervention in terms of getting the demand uplift back there. So that will be one area where I would be a bit watchful.
Interesting. If I'm not putting you in a spot, but if you were to present in front of the finance minister, what would be one or two things that you would want personally to be implemented for the economy to be back in its aggressive form? And as you rightly mentioned, the bottom of the pyramid are affected a lot. It's not a politically loaded question, just from a fund manager perspective, what would be some of your wish list items if you were to meet the finance minister?
Right. I think they've done a reasonably good job. I mean, again, not taking any political undertones at all. Please don't get me wrong on that. Because this is the feedback that we get when we speak to companies as well. What is it that you want further the government to do? And a lot of companies are saying, I think they've done a lot. It is now up to us to invest back into capacities and create the demand, etc. So at one end, of course, the enabling framework, etc., especially, given the significant pulls and pressures that are there, it's not an easy job to execute, right? And so I think there is still a long way of reforms that we can keep incrementally hoping for, and I'm sure the government at the right time would end up doing that. And also that, it's my belief that, we should never look at utopia as the solution. In the sense that we're never going to get there, I think, in our lifetimes. I mean, I would say that, as long as the rate of improvement is on the positive side and the slope is improving, we should, I think there is enough opportunity for businessmen to make more profits. So with that caveat, I would think that, clearly there needs to be slightly more administrative reforms, if not anything else. Judicial reforms, that's the other area which, these are long pending, and I'm sure there are many people far more with greater expertise who kind of, written thesis and recommendations for this. But those would be the two areas. I'm personally someone who believes that, a lot of money is spent on administration. Again, we've got some brilliant administrators, but I think it's disproportionate money being spent on administration, which could be better served elsewhere, is my personal view. But I'm sure they'll take a considered view, given the significant pulls and pressures that each lobby group has.
Very, very interesting and very different viewpoints. Thanks for that. Shifting gears a little bit, Harish, you manage about close to 25K assets under management, and you are basically a career veteran at Kotak Mutual Fund. Tell us a little bit about Kotak Mutual Fund. Your team. What is your research process? How you keep the sectors or the new stocks coming in, and what kind of due diligence do you? Any insights into how Kotak Mutual Fund works would be excellent.
Right, so been fortunate to be part of the overall group This is my 18th year at Kotak. We've had our own evolution. I think the fund management industry in India itself is quite nascent, right? So there were phases where we were cowboys. You go meet a company, and I'm talking about nearly close to 2 decades back, right? And that was the cycle then. It got rewarded disproportionately. You go meet a company, you like it, you buy it the next day, and then you make the money, and then everybody's happy. And then obviously the regime shift happened. And that is when risk management started coming through. And therefore, we started putting the guardrails as to what is it rather. Then there was a phase, personally, if you ask me, wherein we were buying the right names, but still not making money for our investors. In terms of, obviously for us, it's the relative edge or the relative alpha is what we are looking at. So even with buying the right names, there is a particular need for a portfolio construct, a particular way of asset allocation that needs to be practiced, so that even with the right names, you start making money for investors. I think that was the next part of evolution that we were. And again, I'm talking about a 20-year kind of a track. So I'm not saying that this is not something that we focused on. Obviously, all of these got focused on, but priorities keep shifting. So please take off this as more a movie kind of or a journey rather than something that we are lacking now or something. I'm sure we need to improve now also, but that is what we did then, right? Then over a period of time, we moved into an environment wherein we kind of focused on your forensic analysis, because especially in India, while there are a significant amount of companies that are there, we know that certain managements are to be trusted and certain aren't, and therefore we invested significantly in that area with a focus on cash flows and a focus on accounting, so that we are able to have lesser of those mistakes. Obviously, we've all made mistakes, but we are constantly in the journey to reduce those mistakes as we go ahead. We could bring in quant, and this is something that I personally kind of do in Kotak, which is to build up the entire quant ecosystem grounds up using first principles. And over there, it gives us both fundamental based quant and quant based fundamental. Both are two completely different sleeves that we have. One helps us in asset allocation, etc., and other helps us in stock selection. So that is something that we look doing at a significant amount of. Overall, we've got about 14 analysts, each of them, sector veterans who track maybe one or two key sectors. We are fortunate that we've got a long tenure team. So just like me, who's been 18 years in this group, I would think bulk of my colleagues have at least got a 10-year plus kind of a history. So there is a certain wavelength, a certain frequency that we all, kind of resonate with. And therefore, especially in COVID, wherein, 2 years we were pretty much working from home, that kind of helped that, we were constantly in sync. Because we know how each of us think, right, in some sense, and therefore we know how to complement it to our own skills. So it's a reasonably full-fledged team focused on fundamental analysis. We've got a quant team now, which is focused on alternate data. And then you've got the entire ideation process that comes through. And like I said, just getting the names is half the work done. The second part is in terms of seeing how they fit into the portfolio from a 3-4 year period. And then after that, bring in that entire prism of risk management, so that you don't go excessively into a particular name, believing that only your thesis is right? And then you see hopefully the magic unfold over a period of time, wherein we've got reasonably consistent performance over, I would say, the last 10 odd years.
Very interesting insights into how you pick a stock. You did mention about the management quality. That's something that we always hear. I look at all the other metrics, but at the end of the day, if I were to decide, that's on the management quality. Are there any broad guidelines that you look at when you evaluate the management, or is it more like from your experience, and any insights into how you judge the management?
Sure. So I think we've got a process called BMV in terms of our investment process. So B stands for business, wherein we look at broadly two attributes, which is the scalability of the business and the sustainability of the business. Scalability is basically how big can the opportunity be and how can it scale up. Sustainability is primarily looking at all the down cycles in the past and how the company is navigated, right? The second attribute that we look significantly is on M, which stands for management. And here we look at about probably two or three key attributes. One is in terms of alignment of interest. I think that is something that is imperative. And while a lot of people say that promoters own a lot of stock in India and therefore they are completely aligned, I don't really agree, because there are related party transactions. Brand custodians are different compared to what the company is. And so there are enough telltale signs how the main promoter or the main management thinks about minority shareholders and the as a custodian of wealth, rather than believing that it is their company and they want to do whatever they want. So that's something that we look at. The second attribute that we look at is capital allocation. I think this is something that that we've realized that in bad times, capital allocation is actually quite good, because everything is on fire. The management knows when to prioritize and does less mistakes, because they know that they have a problem. It's very well identified and they want to clear it out, and so that they can move on with life, so to speak. It's in good times that mistakes happen, conversely, right? Because that is when the opportunity is seemingly endless and you've got resources, and that is where you start making mistakes. So if you start evaluating both of these very differently, you start realizing that which are the ones which are slightly ahead of the rest of the cycle or of the industry pack, and which are the followers. And because there needs to be a certain amount of counter-cyclicality when it comes to capital allocation, right? In some sense, we are also doing that, but we would also expect the CEOs and the industry captains also to do that. Because that is when they can also make more than industry in terms of profit pools, and they can keep increasing their relevance or salience of profit pools, right? So that's the other attribute that we look at. And the third thing that we look at is cash flows, and that's a very strong focus at Kotak. So there's the saying that top line is vanity. The actual reality is cash flows. I think very early in our careers, we realized that the profit and loss statement. So there are three statements, right? You've got the P&L, profit and loss, you've got the balance sheet, and you've got the cash flows. Invariably, look at any DCF or any projection, you will focus 90% of the time on the P&L, right, of all future things. And balance sheet is just one residual portion, and cash flow is something that you just change 2-3 cells just so that it kind of tallies. What we've realized is actually the cash flow is the most important statement. Then comes the balance sheet, and then comes the P&L. And once we get that clarified in our thinking, I think broadly, we are at least able to, I would say, have lesser mistakes. Mistakes still come through, and that is why we bring in diversification, right? So that even if there is a mistake, we have lesser of an impact to our unit holders than what we would have liked. So that's broadly what we look at. And the third thing, just to complete that series of BMV, the third is valuations, which is based on intrinsic valuations. We arrive at where there is a reasonable margin of safety. So that's broadly our approach in terms of management quality.
BMV. Let me pick your brain on the valuation aspect, because I know you recently did an interview with Ashwath Damodharan also. Let's talk about the recently IPO'd so-called tech companies with high valuations. Investors have got burnt, and a lot of youngsters who went into markets probably believe the hype and all that stuff. Now, the usual Balika Bakra kind of stuff. So when it comes to valuation, how do you see the current valuation trends in India, especially when it comes to the initial public offerings? Any views or any thinking on that?
Sure. So I think there is enough literature to say that IPOs are broadly not stacked in your favor in terms of the odds, because obviously somebody is wanting to sell stock, right? And obviously for 1-2 years it may play out, and then eventually the odds of making money are much more in the secondary markets than in the primary markets. I think that's reasonably well established in India as well as the rest of the world. Having said that, the temptation is always there. That is how it's like the casino, right? It lulls you, it gives you some gains. You think that this is the newfound mantra. You found a winning edge, and then you put in more, and then the house takes it all. And I think we've seen it across sectors, across cycles, across time. This time is no different. The difference I have is, and I've got a slightly different view as far as new age companies are concerned. There's one school of thought that, hey, these are loss-making companies, and therefore we should never look at them. And I'm definitely not in the camp. I'm definitely in the camp that, there are significant value that a lot of these new age companies bring through. And primarily do also appreciate that, the last 10 years when capital or India Inc. was going through a whole zone of, deleveraging and getting its act right. In those 5-7 years, all the capex was done by these unlisted companies. And that is where big money has gone in, and certain habits have definitely shifted. Right. Now, the key question or the key attribute that one needs to ask is, how far is that journey to path to profitability? And once they reach profitability, is the industry structured in such a way that it is amenable to distributive of profits, right? So, in fact, this is something that I've written a reasonably long blog post on Substack, which is on on how to value new age businesses. A long story short, because that's a recently 2,000 word article, but so I would encourage you to look that up. But broadly, the way I look at it is that new age businesses are like options. They are long dated options. Now, in any option, for those of your audience who trade options, you've got a strike price. Right. So in a business, what is the strike price? The strike price, in a conventional business is your debt, cost of debt, or the debt, because that goes straight to the debt holder, and only the residual portion, if the value exceeds that comes to the shareholder, right? That's a typical structure. But in a new age businesses, most of them are debt free. Because they are so new and nascent that no bank would want to give them, and they can't afford those things. So the way you estimate that fixed cost is essentially look at all the fixed costs that are there, which includes the cost of technology, the cost of manpower, and what I call as the consumer surplus, which are the discounts that the company gives over the course of the next 3, 5, 7 years, to arrive at what the hurdle rate for the business is to at least cover, and then to start giving value to the equity holders. So there are some businesses where, for example, cumulatively, they may have spent only $200 million so far over the course of the last, say, 10 years. And they are already making revenues of close to $1 billion, etc. In which case, that the ask rate is lower. And therefore, you have a greater odd of being on the right side of that fixed cost. And therefore, over a cycle, you will be able to make better odds of making money. On the other hand, there are other companies where it's like a black hole effectively, wherein they've sucked in close to about $1 billion, $1.5 billion. Revenues are only about $100 million. And, and therefore, that there is an inherent mismatch whether you want to be on such a cap table, which is so far right. If you get the structure that I'm talking about, but I would strongly urge to look that article up, and because that'll give a lot more clarity rather than these 2-minute kind of spiel. But I long story short, I think new age businesses do add value, but you need to treat them like option values, which means more importantly that you need to have between 2 to 4% of the option value in your portfolio. So if you think that you can have 50, 60, 70% in your demat accounts with just IPO stocks, I think it's a very bad strategy in my opinion. But as long as it's a small portion as an option value, some of them, and fully aware that a lot of them will go dark. I mean, that's the nature of an option, right? but a few of them will make supernormal value creation. And if you write them, I think you will be able to cover those losses and make more than the rest of the pack. So that's the way I look at new age businesses.
Very interesting. Avoid the black holes. And for our listeners, we'll ensure that the link of the said article is given in the description. Thank you, Harish, for that recommended read. Before I ask you to recommend the favorite three books that I normally ask, let's get to know you a little bit better. When you're not evaluating companies, when you're not looking at cash flow statements, what is Harish off work, and what kind of hobbies you have, and how do you spend quality time?
So a lot of my, obviously last 2 years, COVID is a bit different, but generally I like to travel quite extensively. And that's the way I try to unwind. And so that's primarily how I look at unwinding. I also like teaching, but again, yeah, teaching would again be in the same field. But in some sense, I think both writing, I write quite extensively on social media, on Twitter, Substack, etc. I think all of them help clarify thinking more than anything else. So it is more to give myself a better understanding of what my principles are, of first principles. And the good thing is, I think we so much of valuable feedback comes back to constantly keep you thinking that whether in terms of your framework, is there something that needs to be refined. And so I would spend a lot of my time on those two, teaching and writing and traveling. So that's the way I'm currently at least unwinding in the space of life.
Excellent. So you're 24 hours building your mental models as we speak.
Yeah, but I think it never stops. So that's the positive thing, right? It's all about curiosity in our profession. I'm completely blessed that I get to do this for a living. So yeah, make the most of it as I can.
Great. So Harish, before we wrap up, the usual question, please recommend us your favorite three books that will be of help.
Okay. So I think one book that I think a lot of people have found a lot of value, and I rate it as an absolute top read, is Capital Returns. This is a book of the buy side of a firm called Marathon Asset Management in UK. And in some sense, it shaped my thinking in terms of how I looked at companies. And for any serious professional investor, I think that's a must read. To get a sense, because it's very contemporary. It's basically live case studies of the last 15-20 years. So there's a lot of relatability that one can have over there. The second book that I recommend is a book called Creativity Inc. This is a very offbeat or a very differentiated book. In the sense, it basically chronicles the success of Pixar, the animation studio, from its CEO's lens or its founder's lens, right? Now, why is this interesting? Is because investment, in my opinion, is both about numbers and narrative. It is art and science. And so while there is a certain rigor and all of that you bring through, on the analytical side, you need a creativity spark or a creative spark to try and see that same data in a completely different lens. And that is where I think it makes a lot more sense, primarily because, especially if you look at Pixar, and I think now they've churned out even more hits, but that is one animation studio that had, if I'm not, my memory serves me right, about 25 hits, one after another. And it's an incredibly difficult business, right? Creativity, as we all know, to keep sustaining those levels, you need a process. And they define that process so beautifully that I think on an investment side, we can use a lot of those principles to create a framework and to create a team and discipline, and more importantly, a culture that encourages innovation, brings in creativity, and in which case all of us are reasonably, of that analytical rigor. Or possibly what we are lacking is those two elements, and therefore that brings in that spark, right? The third book that I think is very useful, and this is for more the I would say, a newly initiated investor or someone who's just started, right? I think it's a beautiful book called Rebel Allocator. Okay, it's a very small book. It's possibly like a fairy tale. You can finish it off in one session. But it basically says the importance of capital allocation through a story. And the story of an old person and another person who's starting, who interviews him as to how a businessman, forget stock markets and all that, how a businessman actually sees and grows his business, and why is capital allocation so important. So I think, yeah, three different books. One is on contemporary issues of the buy side, or capital return. Second is, like I said, Creativity Inc. And third is Rebel Allocator.
Excellent. This is one of the most diverse set of book recommendations I've heard, and first time I've not heard of any of the books that have been recommended. So definitely, the next thing that I'm going to do is go buy them on Kindle. Thanks a lot, Harish, for spending such quality time with us and giving us such great insights. I look forward to catching up with you again in future. Thanks again.